So today, we're going to talk about a story that's kind of flying under the radar, but it has the potential to send a massive wave crashing across global markets. There's this quiet shift happening in Japan's bond market, and it could be a sign that a decade-long party for investors, well, it might be about to come to a very sudden end.
You can almost think of it like a ghost story for the financial world. See, for over a decade, a really key part of Japan's economy has been, well, dormant, predictable, almost silent. But now, it's starting to stir. It's waking up. And that sudden movement is what's spooking investors all the way from Tokyo to New York. So, what exactly is this ghost that's coming back to life? It all kicks off with this number right here, 1.86%. That's the interest rate or yield on Japan's 10-year government bond, and it has just shot up to its highest level since 2008. Now, I know what you're thinking. Why on earth should I care about a Japanese bond yield when I'm watching US tech stocks or crypto? And that's a fair question. But it turns out this little number is the key to understanding one of the most powerful and kind of hidden forces in all of global finance.
To really get what's at stake here, we have to pull back the curtain and look at the hidden mechanism that's been quietly pumping up global markets for years. A lot of people just call it the world's supply of free money. It's called the yen carry trade. And look, for decades, Japan has kept its interest rates at basically zero to try and fight off deflation. This created this incredible opportunity for big-time investors. You could borrow massive amounts of Japanese yen for practically nothing, and then go invest that money anywhere else in the world where you could get much higher returns. It's basically been the financial system's invisible engine.
The strategy itself is actually pretty simple, but incredibly powerful. First, these big funds borrow yen for pennies. Then, they swap it for US dollars and plow that money into assets with much better returns, things like stocks or bonds. They make their profit from what's called the spread. That's just the difference between the super low Japanese interest rate and the higher return they get over in the US. And this simple process, repeated over and over, has fueled a huge boom in risky assets for more than 10 years.
And the scale of this, it is just staggering. Bloomberg estimates that the total size of these yen carry trades could be as much as $4 trillion. Just let that sink in. That is a colossal amount of money that's been injected into global markets. And it all started with Japan's decision to keep interest rates near zero.
And you can see the impact right here in this quote. A lot of analysts believe this absolute fire hose of cheap money is one of the main reasons we've seen assets like US tech stocks, gold, and even Bitcoin just keep hitting record highs. It's been this constant, invisible tailwind pushing everything higher.
But here's the thing. That invisible engine is now sputtering. As Japan's interest rates finally start to creep up, that entire carry trade is slamming into reverse. And this is what the market is calling the Great Unwinding. This is where things start to get really dangerous. Okay, so here's the core of the problem. Back then, you had Japan's rates near zero and US rates much higher. That meant a big, juicy spread and easy profits. But now, Japan's rates are starting to rise, while everyone expects the US to start cutting rates. So that profitable gap, poof, it's vanishing. The trade just doesn't make sense anymore, and that forces investors to unwind or close out their positions. And this is what kicks off a huge domino effect. To close out the trade, investors have to sell their US stocks and their crypto to get dollars. Then, they have to use those dollars to buy back Japanese yen to pay back the original loan. Now imagine trillions of dollars all trying to do that at the same time. You get this massive selling pressure on the very assets that got the biggest boost from all that cheap money in the first place. This is why so many traders watch the crypto market like a hawk. Bitcoin is incredibly sensitive to changes in global liquidity, which is really just a fancy word for how much cash is sloshing around the financial system. Because it trades 24/7 and has very few barriers, it's often the very first asset to react when that cash starts to dry up. It's kind of like an early warning system, a liquidity EKG for the health of the entire market. We dig into these kinds of deep market mechanics all the time, so if you're finding this useful, do us a huge favor and hit that like, share, and subscribe button. It really helps us out and you won't miss what's coming next.
Okay, so to really understand why this is such a powder keg, we've got to look at the incredible trap that Japan has set for itself after decades of these really unconventional economic policies.
The heart of the problem is this number right here, 250%. That is Japan's national debt compared to the size of its entire economy. It is one of the highest in the developed world. Now, when you have that much debt, even a tiny little increase in interest rates creates an absolutely astronomical bill for the government to pay. And this is where the situation gets really, really precarious. Look at this. Over half of all Japanese government debt is owned by its own central bank, the Bank of Japan. Now, why is that? Well, because for years, there just weren't enough other buyers. The central bank was forced to basically print money to buy its own government's debt. That's what has artificially kept interest rates down and propped up the entire system.
This quote just perfectly nails the impossible choice that Japan is now facing. If they let interest rates rise to make their currency, the yen, stronger, they risk a total collapse in their own bond market as their debt payments just spiral out of control. But if they keep rates super low to save the bond market, the yen will probably just keep getting weaker and weaker. It is a classic catch-22, and there is no easy way out.
So what's the bottom line here? What's the takeaway for investors? This isn't just some abstract theoretical problem. There are very clear signals we can watch for that will tell us if this little tremor is about to turn into a full-blown earthquake for global markets. Here are the 3 things you really need to keep on your radar. First, does the Bank of Japan actually follow through and hike rates again this December or maybe early next year? Second, does that 10-year bond yield we started with break above the really critical 2% level? And third, do we start to see U.S. interest rates getting dragged higher as all those Japanese investors start selling their U.S. bonds? If you see all 3 of those things happen together, well, buckle up because it probably signals a period of major volatility ahead.
And this leaves us with one final and really critical question. For more than a decade, global markets were floating on this invisible river of cheap money flowing out of Japan. That river is now starting to dry up. The question isn't if the cycle is going to change, but whether a market that's become addicted to easy money is ready for the brutal hangover that's coming next.